Asia. Well, let's move ahead and say hi to our next guest. Anand Shah, head of PMS and AIF investments at ICICI Prudential AMC, is joining in. Anand, hi, good afternoon. Good to be speaking to you on a Friday afternoon. So let's start with this move on autos, right? Our colleague Nimesh was just telling us about this one brokerage note, but it's really something. M&M 2.5%, Hero Moto 3.5%. Most of them have had a pretty flying Friday. How are you positioned on the sector, autos or let's say auto ancillary?
Hi, very good afternoon. I think if you see the last couple of years, since the steel prices have sort of corrected, there has been a very strong earnings growth rate. To that extent, the sector had actually underperformed its earnings growth rate. Relatively, if you ask me, they had become fairly cheap also in terms of valuations. But more importantly, what is happening is we had a very difficult year in terms of consumption, at least the last 6 months. So I think a run up to the festive season, it started off on a good note. The base is low, and to that extent, again, as I said, the valuations are low. Yes, people are a little bit of excited that we might get some good growth on a low base. Margins are anyways looking nice given that the commodity prices remain soft.
Anand, afternoon. This week belongs to the PSU Banks. The Nifty PSU Banking Index has rallied 7.5%. Are you a buyer in any of the PSU banks?
We've been, frankly, owners of corporate banks in general and PSU banks also to some extent. And what has changed, if you see from a little longer term perspective, corporate banks actually paid a heavy price of slowdown in manufacturing, infrastructure. If you recall, starting 2015, we had an asset quality review, then we had a demon, RERA, GST, and the NBFC crisis. A lot of NPAs got accumulated and provided for. What we're seeing going forward as manufacturing recovers, you can see we are already talking of power deficit to that extent, utilities picking up, and even the infra turning around. We are seeing those NPAs which are fully provided for, we are going to see some good recoveries there. And the incremental slippage is also not very high given the economy is doing well. So I think banks are generally most leveraged to the economic growth rate. And as we've been talking about all along that there's nothing wrong we are seeing in India. Economy is doing fine. Consumption is expected to pick up from a slow growth last year. And the manufacturing is already doing well. So I think that's all a rub-off effect on the banks that they will have lower slippages and more recoveries from the existing NPAs, which means profitability outlook remains healthy.
Okay, got that. Anand, now, how are you looking at the pockets of the mid-cap market that were running red hot? And I'm, of course, talking about manufacturing, PSUs, CapEx, defense, right? So what is the approach going to be? Have you lightened positions as we've run up to this 20,000 level? Are you still holding? Would you buy more? What are you doing here?
Very tough question, but let me try. So I think that the trick is to go bottom up. To be very honest, there will be some of the stocks which don't deserve to be where they are. Definitely, there are some stocks which are more thematic or more stories rather than actual underlying. But we own, or rather, we manage quite a lot of small cap and a mid cap money as well. And when we look at our own portfolio, we are finding that pockets of companies in manufacturing which were not doing well for almost a decade and a half, especially since 2010. It's been a very tough time for many of these industrials, capital goods, industry product companies. Many of those are, their utilizations have picked up, margins are looking good, exports, some of them have actually captured some of the exports market. So all in all, I think it's time to be bottom up. We find a lot of value in many of mid and small cap companies. You spoke about PSU Banks being one of them, where again, yes, there has been a a lot of painful period in the past, but the outlook looks positive. So the trick is to go bottom up, do a lot of fundamental research, analyze them, predict the cash flows, and look at the valuation at which you're buying them.
Do you want to throw a little more color on, some ideas in this mid-cap space? Because money is flowing in thick and fast into the mid and small cap universe. You're managing money. So if you had to put fresh money to deploy right now in the mid-caps, which pockets would you look at?
So again, I'm saying it's a tough one because, when we were investing in small caps, we were very much overweight on manufacturing, industrial cap goods, logistics, utilities, and they were fairly cheap 2 years back, 3 years back. Today, we have seen sharp rally there as well. Nevertheless, there is a strong earnings also. We're actually holding on to our portfolio. We continue to like select companies in metals, select companies in industrial products, select companies in cap goods. I think more broadly, if you dissect large caps and mid caps, small caps, in India, the top 100 companies have very little manufacturing and manufacturing-related business. It's dominated by consumers, banking, financial services, IT services. So if you really expect that manufacturing in India will do well, you have no choice but to go mid cap and small cap. And that's where those who have survived the tragic 10 years when China was exporting deflation to the world and manufacture in general suffered, those who have survived those difficult 10 years, I think they're all looking good. Their balance sheets have improved, their cash flows have improved, their cost competitiveness has improved. So I think we are finding many strong ideas across textiles, across auto hangs, across generally in manufacturing.
Okay, so that's the sense on manufacturing. Anand, then, finally, in this market, are you even thinking of any fresh ideas on the horizon? Anything new, or basically maybe anything that's forgotten, because we've been so busy, preoccupied talking about capex and engineering and manufacturing. Any other areas that one should start looking at?
Indeed, I think while we captured the manufacturing early on, we were looking at what is the allied beneficiaries of manufacturing. One of them obviously was corporate banks, but the other one, which is more recently come into limelight, is power. Look, the utilities have been, in a way, sort of a very low growth environment for a while. They also did stop the capex. We've been for a very long period of time not intending to put large capacities in thermal power plant because of ESG and other issues, but most importantly, the demand was slow. What has happened over the last 2 to 3 years is all the spare capacity in power plants have been sort of utilized, and we have now reached a point where August, we all know, was a deficit month. We had a peak power deficit, which was very large, and to that extent, all of a sudden, there is a sense of urgency to see to it how we produce more power. So I think many segments, which includes the utilities, but also the allied businesses, balance of plant, cap goods, we are seeing all around, interest in those areas. And we've been sort of, even REC PFC for that matter, has been a limelight. So those are the various allied businesses, as we are talking about, which have been sort of, should be looked upon, is what I would say.
Okay, got that, Anand. Thank you very much. Good talking to you as always. You have a great weekend, and we look forward to connecting again soon. Well, with that, we have to take a very quick break. Come back on the other side. As always, a check on what dealing rooms are doing this Friday. We'll have Nimesh back in our special segment, D Street Chatter. And, of course, some final calls coming up on the trading side with Mitesh as well.